Welcome back to our finance and investing channel. Today's date, April 7, 2025, has stirred tremendous interest, owing to President Donald Trump's declaration that this is Liberation Day, the moment when the United States is supposed to introduce what is claimed to be the largest wave of tariffs in modern history. The atmosphere is rife with speculation, and multiple questions dominate public discourse. Will this serve as the dawn of a revitalized American economy, as the administration has promised? Or is it the start of a nightmare scenario, one that could entail runaway inflation, abrupt recession, and even a full-blown global trade war? How might these developments directly affect our pocketbooks as both consumers and investors? And beneath the surface, what sorts of threats and opportunities might emerge amid the chaos of what Trump has grandly labeled the Day of Liberation? Throughout this broadcast, we aim to shed light on these pressing questions. While the administration insists that imposing extensive tariffs will free the United States from what it characterizes as decades of unfair trade practices, many remain skeptical. Could this be a bold stroke to restore manufacturing jobs and economic growth? Or will it fuel a chain reaction of retaliatory duties that triggers a devastating market sell-off? The White House's emphasis on immediate effect for these tariff measures is itself a radical departure from more typical, phased-in approaches. This sense of urgency has left analysts, foreign governments, and large corporations alike scrambling to interpret the specifics and the potential fallout. To heighten the drama, President Trump has packaged the announcement in a distinctly symbolic wrapper. He likens this day to an emancipation for American workers, contending that hidden or overt foreign barriers have systematically disadvantaged U.S. manufacturers for years. According to Trump's narrative, the new tariffs will bring that era to an end, compelling multinational companies to return production stateside. Although the administration has circulated rosy predictions of surging domestic hiring, the thorough details surrounding the plan remain murky. In fact, on the eve of the announcement, the White House had yet to release a definitive list of nations subject to the new universal rate. Rumors swirled of a 20% blanket tariff, perhaps climbing to 25% on specific product categories, yet statements by top officials also hinted at possible exemptions. With so little clarity, markets are left guessing, which alone has sparked volatility. If uncertainty is the bane of investors everywhere, then these times are prime breeding grounds for fear. The only aspect that seems certain is the unprecedented scope of the administration's ambition. While Trump's first term saw tariffs placed on goods worth approximately $380 billion, speculation now points to a figure almost 10 times that size, potentially exceeding $3 trillion in imports. That scale has drawn parallels to the extreme protectionist measures of late 19th century America, inviting both alarm and fascination. Furthermore, these new duties do not emerge in a vacuum. They build atop prior measures from the second Trump administration, such as a 20% tariff on Chinese goods and a 25% tariff on steel, aluminum, and imported autos. In effect, this so-called Liberation Day is more like an apex, a culmination of months of intensifying protectionism. Over the next few segments, we will dissect the significance of this announcement from several angles. First, we will investigate the market's immediate reaction and the apprehension swirling on Wall Street. Then, we will examine how everyday consumers might shoulder the burden of higher prices, especially at a time when many households are already struggling. We will also consider the risk of global repercussions, particularly if major trading partners respond with their own tariffs. Finally, we will explore whether investors can find silver linings in what appears to be a financial storm on the horizon. Let's take a deeper dive and see how this Liberation Day may actually shape the months and years ahead. Let us start by examining the fanfare surrounding President Trump's designation of April 7th as Liberation Day. In essence, this moniker forms part of a larger symbolism aimed at rallying support behind a radical vision. According to the administration's rhetoric, the United States has long been bound by what it frames as unfair trade agreements and predatory practices, with foreign partners taking advantage of the American market's openness. Trump's overarching aim is not just to boost tariff revenue, but to liberate U.S. workers from foreign competition, ushering in a new industrial renaissance. Yet behind the triumphant label, critical uncertainties abound. leaving investors and economists struggling to piece together a coherent picture of what to expect. Central to the confusion is whether the new measures constitute a uniform levy, say a flat 20% tax on all imports, or whether the plan relies on a reciprocal approach that targets each country differently, mirroring perceived duties faced by U.S. goods abroad. Some advisors hint that major allies may receive exemptions, while others warn that the administration wants no carve-outs at all. This lack of clarity, ironically, has caused enormous volatility in currency and equities markets worldwide. Despite speeches exalting Liberation Day, the White House remains tight-lipped about explicit details, fueling a wave of conjecture and uncertainty. Compounding matters is the fact that these policies coincide with a flurry of other tariff announcements. Months prior, the administration had already reimposed a 25% duty on steel and aluminum, extended coverage on automobile imports, and heightened scrutiny of goods from key trading partners like Canada, Mexico, and China. Taken individually, each measure signaled a robust protectionist stance. Taken together, they create a mosaic of barriers that threaten to reset the rules of global commerce. Critics point out that these actions could escalate friction with strategic allies. For example, Canada and Mexico, heavily integrated with U.S. supply chains, have responded by threatening retaliatory duties, while the European Union has signaled dismay at the scope of potential American surcharges. Japan, historically cautious in trade disputes, has also signaled it will not stand idly by if tariff hikes severely hamper its exports. The net effect is a swirl of anxiety on Wall Street, where investors normally prize predictable policies. Indeed, stock indices have exhibited a roller coaster pattern in recent months. Reports or rumors of pending tariffs often prompt sudden sell-offs, only to be followed by temporary rebounds when the administration temporarily halts or softens its stances. Across Asia and Europe, markets have followed a similar rhythm, battered by the unpredictability emanating from Washington. With Liberation Day looming, that anxiety has recently risen to a fever pitch. Many wonder whether this final piece of the puzzle will prove so sweeping that it undermines entire industries reliant on overseas inputs, thereby triggering a cascade of cost increases down the supply chain. It is not merely the equity traders who are alarmed. Financial giants such as Moody's Analytics and Goldman Sachs have slashed near-term growth forecasts for the United States. They warn that if wide-ranging tariffs precipitate a tit-for-tat cycle of retaliation, the result could be a significant surge in unemployment and a noticeable contraction in GDP. Beyond the direct impact on manufacturing, consumer spending might also take a hit should prices increase for ordinary household items. Already, some leading retailers have expressed concern that if import costs climb, they will have no choice but to raise prices at a time when many consumers are already showing signs of budget stress. Meanwhile, prominent economists label the environment as chaotic, invoking the specter of the 1970s and its mix of high inflation and low growth. Others draw parallels to trade wars of the early 20th century, which proved deeply damaging to global economic confidence. Market turbulence, however, is only one dimension of the Liberation Day story. The deeper worry among many analysts is how these policies might affect American consumers, whose spending drives approximately 2/3 of U.S. GDP. If tariffs inflate costs on electronics, clothing, household goods, or automobiles, the immediate effect could be a wave of price hikes that reduce purchasing power across various income brackets. President Trump has indicated he wants Americans to choose domestically produced cars over imported models. Yet, it remains unclear if domestic manufacturing has the capacity, or the cost competitiveness, to meet consumer demand at scale. Should foreign supply evaporate or become prohibitively expensive, a shortage of inventory and an overall jump in sticker prices could be the new reality. Even prior to Liberation Day, several leading retailers noted an abrupt decline in foot traffic. Their quarterly reports reveal that consumers have been tightening belts amid a confluence of factors: stagnating wages, rising fuel and energy costs, and a spike in credit card debt. If these difficulties worsen, households may struggle to cope with broad-based price increases. Moreover, many families who had built up reserves during earlier stimulus phases indicate that their savings are now depleted. The combination of elevated inflation, ballooning debt, and limited wage growth could hamper any near-term economic resurgence that the Trump administration envisions. Beyond the pricing question lies a broader fear of job losses. In theory, tariffs might resurrect American factories, but reality can be more nuanced. Manufacturers reliant on global supply chains could face sudden cost spikes if they import parts from newly penalized nations. Those costs could lead to downsizing or even relocating operations to circumvent the duties. Certain industries, like consumer electronics, are deeply intertwined with Asian supply hubs, making it difficult to revamp production lines in the short run. Consequently, while some sectors might attempt to reshore jobs, others may slash payrolls due to surging costs, offsetting any gains in American employment. Moody's worst-case scenario, for instance, projects losses of more than 5 million jobs if global retaliation intensifies, driving the jobless rate well above 7%, a stark rise from today's relatively low figures. For everyday Americans, the pinch might be felt at the supermarket checkout and online shopping carts. With half of all consumer goods in the U.S. imported from abroad, even a partial rise in tariffs could cascade into higher costs for food, apparel, electronics, and home essentials. The data from the early months of 2025 reveals a pronounced slowdown in consumer spending as families grow more cautious. Retail executives claim that many shoppers are running out of money before they run out of month, underscoring financial fragility. An added wave of tariffs, layered upon existing concerns, stands poised to amplify what has already been a precarious situation. Then there is the psychological dimension. Consumer sentiment surveys have documented a sharp decline in optimism, partly tied to anxieties over job security, credit constraints, and uncertain government policy. If sentiments erode further, households are prone to pull back even more, generating a feedback loop of reduced demand and slower growth. This dynamic, widely known as the wealth effect, typically operates in reverse. People spend confidently when they perceive stable gains in stock portfolios, property values, or incomes. In times of trade upheaval, however, fear can become self-fulfilling. As consumption slackens, revenues dip, and companies scale back investment or freeze hiring, culminating in further consumer caution. Hence, while Liberation Day conjures images of triumphant parades, the lived reality for many American households may be that they face a cost of living spike at the very moment they can least afford it. In a worst-case scenario, that push might tip the economy into recession territory, especially if the Federal Reserve reacts to the resulting price inflation by raising interest rates. Next, we will examine how global markets and major trade partners are likely to retaliate, and whether this day signals a looming crisis with worldwide implications. A spotlight naturally falls on how key foreign partners will respond to this new era of American protectionism. With the U.S. poised to deploy an unprecedented scope of tariffs, other major economies have already signaled readiness to defend their interests. Canada, for instance, has set up a crisis response team under Prime Minister Mark Carney. Previously known for his tenure at the Bank of Canada and the Bank of England, Carney is well versed in financial turmoil. He has described Trump's initiative as a direct blow to Canadian labor. Although details of Ottawa's countermeasures remain opaque, insiders talk of imposing duties on billions of dollars of U.S. exports, zeroing in on regions key to Trump's political support. The European Union, typically a champion of open trade, likewise has not minced words. Ursula von der Leyen, president of the European Commission, decried the policy as harmful to consumers everywhere. She referenced the possibility of slapping proportionate tariffs on American goods, from agricultural products to high-end technologies. European officials also warned that they will challenge the U.S. at the World Trade Organization, alleging that national security arguments have been stretched beyond their intended scope. Japan, meanwhile, sits uncomfortably on the sidelines, but analysts predict that it may react with calibrated measures if the tariffs severely impact its automotive exports. Across the Pacific, China, which previously encountered confrontation with the Trump White House, is expected to retaliate swiftly if hammered by fresh duties. The upshot is a potential chain reaction, an all-encompassing cycle of protectionist measures and retaliations that could disrupt global supply chains. How would such a spiral affect the broader world economy? For some experts, the specter of a global trade war feels closer than it has in decades. Although the 1930s are often cited as the prime example of destructive tariff spats, even more recent episodes, like the late 2010s, demonstrate how quickly tensions can escalate when large powers pursue conflicting aims. Today, with advanced interconnections spanning every continent, the damage from severed ties could be widespread. If intermediate goods become more expensive, manufacturers might shut plants or shift them to more stable countries. That process, however, is neither cheap nor quick, which might dampen growth prospects across multiple regions simultaneously. Compounding matters is the fragile state of the global service sector. In many developed countries, services account for a significant portion of GDP and employment. When trade in goods seizes up, consumer and business confidence suffer, leading to reduced spending on everything from travel and leisure to consulting and logistics. Recent data from crucial U.S. service sector regions, Philadelphia, Chicago, New York, show a clear slowdown. If that trend continues or is exacerbated by new tariffs that raise the cost of inputs and transport, these vulnerabilities could intensify, undermining a sector that was once considered resilient. Meanwhile, major institutions are on high alert. The International Monetary Fund has cautioned that intensifying trade disputes might lop off significant fractions of global growth. Central banks around the world are grappling with contradictory signals. On one hand, they may need to cut interest rates if a global downturn accelerates. On the other hand, they risk fueling inflation if tariffs drive consumer prices higher. The overall environment looks primed for volatility, with each new threat or retaliatory move casting ripples across equities, bonds, and currencies. Those searching for clarity find little comfort in the interplay of national pride, strategic alliances, and economic necessity. As the potential for a deeper slump looms, it becomes clear that Liberation Day could reverberate far beyond American borders, shaping a future of heightened trade barriers and fractious diplomacy. Next, we will pivot to how this climate affects individual market participants. With so much disruption, cautious watchers may wonder if there's any room for optimism, or whether every new piece of news spells more trouble. As we'll see, not all is doom and gloom. Even in periods of turmoil, informed and disciplined investors can position themselves to endure, perhaps even benefit from, the swirling crosscurrents. Before we turn to potential investment strategies, let's touch on the Federal Reserve's predicament in this fluid setting. If fresh tariffs spark a rise in consumer prices, the Fed could interpret it as an inflationary threat that necessitates preemptive rate hikes. However, such tightening would risk compounding the danger of a recession if households pull back further on spending and businesses cut back on hiring. Conversely, should the Fed lean dovish, attempting to buoy growth through low interest rates, it might unintentionally stoke inflation if prices spike due to trade barriers. In short, the Fed stands on the knife edge of a stagflation scenario, recalling the painful era of the 1970s when high inflation collided with weak economic growth. This tension has investors closely watching every utterance from top Fed officials. The Chicago, Philadelphia, and Richmond branches, for example, have each flagged concerns over the potential downturn. So far, the Federal Reserve's official communications stress that they remain data-dependent. But with data in flux, markets are left guessing whether rising car costs or pricier imported raw materials will push the Fed to resume hikes. Indeed, bond yields hint that recession fears may outstrip inflationary anxieties. Yields on longer-dated treasuries have fallen, reflecting pessimism about near-term growth. A flattening or inverted yield curve often predicts an economic pullback, a signal that can reinforce caution among lenders, borrowers, and equity investors alike. It is not just about a single pivot in monetary policy either. The U.S. budget deficit is expanding, fueled partly by ongoing tax cuts and the potential for increased defense spending. Should the government borrow more at a time when interest rates are still comparatively low, it might fan the flames of inflation further down the road. Meanwhile, the Fed's capacity to fight a potential recession is in question. After the pandemic-driven crises earlier in the decade, the Fed resorted to aggressive moves like quantitative easing and near-zero interest rates. Many experts wonder how much ammunition remains if a severe downturn hits again, particularly if that downturn is triggered by trade disruptions rather than a typical financial cycle. Complicating all of this is the White House's strategic use of national security rationales for imposing tariffs. Since the executive branch wields substantial authority in matters of security, the president can bypass certain legislative checks. Critics argue that Congress's oversight is being undermined, as some lawmakers balk at the notion that steel or car imports constitute a bona fide security threat. Yet the administration's approach persists, binding trade policy with the broader objective of reaffirming presidential power. Should foreign governments contest these measures in trade courts, legal battles could drag on for years, leaving businesses in prolonged limbo about sourcing and investment decisions. For investors, the upshot is a volatile environment in which foreign exchange rates also fluctuate. Countries penalized by tariffs may let their currencies weaken or adopt other countermeasures, further distorting global trade balances. American exporters, ironically, may find it harder to sell abroad if partners impose reciprocal duties or if the US dollar strengthens. All told, the systemic fragility might lead to a scenario in which neither inflation nor deflation stands out, but instead a chaotic mix. On top of that, political cycles can shift drastically, meaning future administrations might reverse the policies put in place on Liberation Day. That unpredictability complicates any planning horizon that extends beyond a few years. Within this swirl, prospective or current investors must grapple with how best to safeguard their assets. Is there a safe haven left, or do all markets remain at the mercy of sensational headlines? Might certain sectors, ironically, fare better, such as domestic materials, construction, or infrastructure? In the following paragraphs, we'll outline a few guiding principles for navigating these storms, along with potential vantage points for those willing to embrace calculated risks. For individual investors looking to chart a course through the chaos of Liberation Day and its aftermath, the single most vital principle is managing emotion. Dramatic policy announcements can spark fear, whereas talk of a manufacturing renaissance can entice greed. Experienced investors often caution that success stems not from reacting impulsively, but from adhering to clear-eyed strategies grounded in personal risk tolerance, financial goals, and disciplined execution. Panicked selling during market dips frequently leads to locking in losses, while chasing hype during surges can result in overpaying for assets at inflated prices. In uncertain times, stability often stems from rational planning rather than sensational reflexes. One foundation to consider is your overall financial health, including your emergency fund and debt profile. If a recession hits or mass layoffs occur, a stash of liquid savings can carry you through economic turbulence. Carrying less high-interest debt diminishes vulnerabilities if interest rates climb. With that base secure, it becomes easier to seize opportunities that arise when markets dip or certain sectors look undervalued. This approach mitigates the risk of being forced to sell quality investments simply to cover unexpected expenses. Next, examine your asset allocation. Diversification remains a timeless principle. Stocks might be battered by trade headwinds in some segments, but others could thrive, especially those tied to American infrastructure, domestic consumer staples, or essential goods less susceptible to discretionary cutbacks. Meanwhile, bond markets could offer relative safety, though one must weigh the possibility that if tariffs cause inflation to surge, long-duration bonds might suffer. Balancing short-term bonds and inflation-protected securities can hedge against abrupt shifts in monetary policy. Alternative assets like gold or real estate could also provide a buffer, though each has unique complexities. Additionally, a distinction arises between passive and active investment styles. Passive strategies, like regularly investing in index funds that track a broad swath of the equity market, can serve as a straightforward, disciplined way to weather storms. Dollar-cost averaging, where you invest a fixed sum at regular intervals regardless of price movements, helps maintain consistency and reduce emotional swings. By contrast, active strategies attempt to capitalize on market dislocations caused by upheaval. If you have the time and expertise, you might spot undervalued companies that, despite negative headlines, hold robust fundamentals. Yet active approaches require deeper research and a higher risk appetite, so they may not suit everyone. In volatile environments, it is also crucial to maintain awareness of global developments. If a tit-for-tat tariff escalation materializes, supply chains could shift in unexpected ways. Some emerging markets might suffer if they depend heavily on exporting to the US or face currency crises. Others could emerge as winners by filling gaps left by large-scale barriers. Keeping tabs on exchange rates, bilateral trade deals, and government statements can reveal new frontiers or hidden pitfalls. Sector rotations might occur as well. If commodity prices surge due to supply disruptions, related stocks could jump, while consumer-focused sectors might lag under inflationary pressure. Lastly, humility and resilience are assets in themselves. Economic cycles do not last forever, and abrupt policy changes sometimes reverse more quickly than expected. Though Liberation Day represents a major shift, politics can alter course if widespread discontent arises or if another electoral cycle ushers in different leadership. Being too certain about any single outcome can blind you to new evidence. In short, stay open-minded. Remain vigilant for signs that the trade fiasco is either cooling off or intensifying. Above all, adhere to fundamentals. Purchase assets you understand with a margin of safety. And do not gamble money you cannot afford to lose. By applying these principles, investors can tread more confidently, even as others panic. Next, we will consider how these guidelines come together in evaluating possible opportunities in the face of a seemingly chaotic market environment. Despite the ominous clouds gathering over global commerce, history reveals that moments of upheaval can yield unprecedented openings for those prepared to pivot. When fear dominates headlines, valuations in certain market segments can tumble to enticing levels. Contrarian investors who study fundamentals may find quality stocks trading at sharp discounts, particularly if panic selling extends beyond truly at-risk industries. For instance, domestic infrastructure firms might benefit from new demand if companies relocate production to U.S. soil to avoid tariffs. Some smaller manufacturing outfits, overshadowed by bigger names, might see an uptick in orders as large multinationals scramble for alternative supply chains. The real winners, however, will likely be those enterprises nimble enough to adapt, maintaining healthy cash flow and forging stable partnerships. Still, one must not underestimate the hazards. Countries threatened by American duties could enact their own versions of Liberation Day. If the European Union or Canada slaps a steep levy on U.S. exports, industries reliant on foreign revenue might suffer, pulling down market indices. Sectors like agriculture, aerospace, or consumer goods could be hit hard if their overseas markets dry up. Furthermore, if inflation jolts higher due to elevated import prices, the Federal Reserve may push interest rates up, inflating borrowing costs and pressuring leveraged companies. That spiral could reverberate across real estate markets, consumer lending, and corporate balance sheets, intensifying the negative cycle. Caution, therefore, is paramount. In uncertain circumstances, systematic investing strategies might help. For instance, splitting your portfolio across multiple asset classes, equities, bonds, real estate, precious metals, dampens the volatility from any single shock. If global meltdown fears spike gold prices, that portion of your holdings could offset losses in equities. Meanwhile, if trade tensions eventually subside, stocks might rebound strongly, compensating for less stellar returns from conservative assets. This dynamic reaffirms why old-fashioned asset allocation often outperforms attempts at short-term market timing, which can easily go awry amid a swirl of contradictory news. Another angle to consider is the policy environment. Some analysts speculate that, should the U.S. enter a swift economic downturn, Washington might pivot to stimulative measures like infrastructure spending or renewed tax relief. If that scenario unfolds, companies involved in construction, engineering, or public works might see a surge in contracts. Conversely, if public finances deteriorate, the government might resort to new forms of revenue collection, potentially straining certain sectors with additional fees. Keeping a close eye on legislative developments in Congress could provide early clues about forthcoming winners or losers. Meanwhile, do not forget the power of consumer sentiment. Even slight improvements in employment data or wage growth can offset higher import prices, stabilizing household spending. Alternatively, a wave of negative job cuts announcements could overshadow any optimism about reshored factories. Every investor should watch labor market indicators, retail figures, and corporate guidance for signs of the economy's true direction. Data reliability also matters. In politically charged times, contradictory reports and spin are plentiful. Seeking out multiple sources can paint a more accurate landscape. Finally, for those still daunted, there is no shame in a more defensive posture until the fog lifts. Shorter-term U.S. Treasuries, certificates of deposit, or money market funds can preserve capital while generating modest returns, though they might trail inflation if prices soar. This approach buys time, letting you adjust once better visibility emerges. Remember that investing is a marathon, not a sprint. A calm, methodical approach can carry you further than a flurry of reactionary trades. In the concluding paragraph, we will consolidate the key lessons gleaned from this entire discussion, offering a final perspective on how to navigate Trump's Liberation Day, the shifting global order, and the unpredictable months that lie ahead. Bringing it all together, Liberation Day stands as a pivotal milestone in the Trump administration's second term, representing a high-stakes attempt to reshape the nation's economic future. On the surface, it is marketed as a grand liberation from unfair trade pacts, but the immediate fallout raises questions about inflation, recession, and the stability of international alliances. Amid this uncertainty, stock markets have shown violent swings, consumer confidence has wavered, and major trade partners are lining up potential countermeasures. Even beyond U.S. borders, ripples from these tariffs could undermine global supply chains, weigh on service sectors, and spur fresh monetary policy dilemmas. The possibility of a multi-front trade war looms. From the vantage point of ordinary Americans, the concept of liberation might ring hollow if daily costs spike and real incomes lag behind. People grappling with credit card debt, stagnant wages, or job insecurity are hardly in a position to applaud pricey imports, especially for basic necessities. The subsequent round of inflation, if combined with a slowdown in consumer spending, might push the Federal Reserve to implement policies that inadvertently deepen a downturn. In the meantime, corporations are scrambling to reevaluate supply lines, factoring in potential tariffs, and anticipating different countries' retaliations. Such fluidity fosters an atmosphere of tension and caution. For individual investors, the new reality calls for both prudence and adaptability. The drama unfolding on Capitol Hill and in presidential statements should not dictate hasty portfolio shifts, yet these signals cannot be ignored. On one side, an inflation spike is conceivable, suggesting a need for assets that can preserve value, such as inflation-protected bonds or certain hard commodities. On the other side, a recession might emerge if high prices squeeze consumers and hamper growth, implying that safer havens and robust balance sheets are crucial. The tension between those two extremes underscores why broad diversification, both domestically and internationally, can offer a resilient shield. Maintaining a disciplined approach through consistent investing, robust savings, and thoughtful debt management fortifies one's ability to withstand potential market storms. Crucially, the story does not end at American shores. Allies and rivals alike seem ready to protect their interests, creating a precarious balancing act on the global stage. Tighter trade barriers may encourage some supply chains to pivot, but the costs of such realignments can be substantial and the time frame uncertain. Markets abhor extended doubt, yet that is precisely what they face if the administration refuses to detail its plans or if countries launch incremental retaliations over several months. For many businesses, the only strategic response is to stockpile goods or freeze expansion until the dust settles. Choices that, in aggregate, can hamper economic dynamism. Looking ahead, one cannot discount the possibility of a policy U-turn should discontent rise. Public opinion can shift rapidly when confronted with higher bills at the grocery store or mass layoffs in vulnerable industries. Moreover, global markets have proven stubbornly resilient when fueled by scientific innovation, technological breakthroughs, and entrepreneurial drive. Some contrarian voices even view the turmoil as a crucible out of which stronger companies will emerge. Such possibilities highlight that, even in the face of dramatic policy swings, the American and global economies can adapt given enough time. As you navigate these crosscurrents, remember the core tenets we have emphasized. Keep a clear head, deepen your financial knowledge, practice disciplined portfolio management, and stay alert to real-time indicators of change. No single policy can definitively make or break an economy as large and diverse as that of the United States, but misguided moves can inflict damage that lingers. Liberation Day, for better or worse, symbolizes a dramatic shift whose full impact will manifest over months or years. By remaining informed and flexible, investors and consumers alike can endure whatever storms arise, emerging more seasoned and prepared for subsequent chapters in an ever-evolving economic narrative.